Something really strange is happening in the stock market right now. On the one hand, you hear headlines screaming that the Nifty 50 is hitting all-time highs, record after record. But then you look at your own portfolio or talk to other investors, and it just doesn't feel that way. It's like there are two completely different markets out there. So today, let's unpack this tale of two markets.
But before we jump in, just a quick reminder, this is all for educational purposes. We're here to connect the dots and understand the data, but this is definitely not financial advice. All right, let's get into it.
So here's the big puzzle we're going to solve. How on earth can the Nifty 50, which is supposed to be the benchmark for India's biggest companies, be absolutely soaring, while at the same time the broader market feels like it's in a deep, painful correction? It just doesn't seem to add up.
And look, this chart right here says it all. It's so stark. On one side, you've got the Nifty 50 chugging along with positive returns, and on the other, the Nifty Small Cap 250 down almost 12% over the last year. That is a massive, massive gap. So let's dig into what's really going on behind these numbers.
Okay, so first up, we need to understand what's actually propping up the Nifty. And the truth is, this rally is basically being carried on the shoulders of a very, very small group of stocks.
You see, the Nifty 50 isn't an even playing field where every stock has the same say. Far from it. Financial services alone make up a gigantic 37% of the entire index. Then you throw in oil and gas and automobiles, and suddenly just 3 sectors are dictating more than half of the Nifty's movement. So when these guys do well, they can literally pull the whole index up with them, even if everything else is sinking.
And here they are, the specific companies doing all that heavy lifting. We're talking about massive returns from names like Eicher Motors, Bajaj Finance, and even Bharat Electronics in the defense space. The performance of just these few large, stable companies has been so incredibly strong that it creates this illusion of a booming market-wide rally.
So you've got to ask, why these stocks? Why now? Well, it really boils down to a few key things. When the economic picture looks a bit uncertain, big investors don't want to take risks. They run towards safety and quality. Plus, these stocks are super liquid. It's easy to buy and sell huge amounts without moving the price. And the big one? They're riding some major economic tailwinds, like India's strong growth and very supportive government policies.
All right, so that's the shiny, happy side of the story. Now, let's flip the coin and look at what's happening pretty much everywhere else. Because while the giants are feasting, the rest of the market is in a world of hurt.
Let's take specialty chemicals. Remember when this sector was the darling of the market? Everyone was piling in. But now, it's facing what you'd call a perfect storm. Global demand is weak, clients are trying to get rid of their existing inventory instead of buying more, and all of that is squeezing their profits big time. The results has been a really sharp, painful correction.
And you're seeing a very similar story play out in mid-cap IT. Their big clients in places like North America and Europe are getting nervous about the economy, so they're cutting back on any spending that isn't absolutely essential. That directly translates to weaker demand and, you guessed it, a whole wave of earnings downgrades for these IT firms.
And all of this pain across all these different sectors is captured in that one number we saw earlier, negative 11.9%. This isn't just a small dip. It's a really significant, broad-based decline affecting hundreds of smaller companies. And it's completely hidden if you only look at the Nifty 50 headline.
So, we've got the giants rallying and the rest of the market falling. We've seen both sides of this story. But the biggest question is why? Why is this great divide happening? Let's unpack the reasons for this polarization. A huge piece of the puzzle is just following the money, the big money. You've got foreign institutional investors, FIIs, who are getting nervous about global risks, so they're pulling their money out and selling off what they see as riskier small-cap stocks. But at the same time, our domestic institutional investors, DIIs, like our local mutual funds, are stepping in to buy. But what are they buying? They're sticking to the big, safe, large-cap companies.
And this isn't just a small trend. Look at this. Foreign ownership of Indian stocks is now at a 13-year low. A 13-year low! That withdrawal of foreign money is a massive headwind for the broader market, and it especially hurts those smaller stocks that the FIIs are dumping.
The next reason? Valuations. Think of it like a price tag. The large-cap stocks are trading near their normal 10-year average price tag. They look fairly valued. But the small caps? Whoa, their price tag is way up there, trading at a price-to-earnings ratio of over 28, which is way, way above their historical average. They just look really expensive, especially when their performance isn't backing it up.
And that brings us to earnings, because this is really key. It's not just about the price, it's about the performance. The large cap companies are for the most part delivering what they promise, steady, predictable earnings. But in the small cap world, it's a story of widespread disappointment. A huge percentage of them are missing their targets, and their overall earnings are actually going down.
So, when you put it all together, you look at where the money is going, you look at the price tags, and you look at the actual company performance, a very, very clear verdict starts to emerge.
And really, this whole situation can be perfectly summed up in one single phrase. It's a flight to quality and liquidity. That's it. Investors are running away from risk and speculation. Instead, they're paying up for the safety, the stability, and the predictable profits of these large, high-quality companies.
So the single most important thing to take away from all this is that the Nifty 50's all-time high is, in a way, an illusion. Sure, the number is technically correct, but it absolutely does not reflect the health of the overall market. The rally you're hearing about is being driven by a tiny group of stocks, while the vast majority are actually struggling.
And that leaves us with the big million-dollar question, doesn't it? What happens next? Is this a story where the earnings of all those smaller companies finally rise up to justify their high price tags? Or is it a story where those price tags have to come crashing down to meet reality? That's the key dynamic we'll all be watching. Thanks for tuning in.